Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 7th of February. I'm Daniel Lam, your host for the podcast. Yesterday, I was having lunch with a few fathers of young chess players in Hong Kong. Now, naturally, the conversation had to start off with the globally well-publicized issues from a football exhibition match over the weekend. One of the parents paid tickets to watch it, and he commented that, well, at least he made the money back, with Hang Seng Index going above the 16,000 mark again. Well, investors had faded the announcement of the RRR cuts 2 weeks ago. But yesterday, there was another big move up to the news that the Central Huajin Investment has been increasing holdings of ETFs recently and will continue doing so. The CSRC also says it will continue to encourage institutional investors to enter the market more vigorously. Now, of course, we highlighted in previous podcasts this year that the wealth effect is important to generate consumption in order to reignite the positive loop into economic growth and eventually filter down to company earnings and to the stock market. To this end, the CPI and PPI figures this Thursday will be closely watched. Standard Chartered Bank Research expects CPI deflation to stay at 0.3% year-on-year in January, partly due to a high base. Now, on a month-on-month basis, pork prices ease further, while fuel and travel-related services may have picked up. PPI deflation is likely to pick up on falling metal and energy prices. Now, in terms of money growth, it is likely to moderate to 9.5% year-on-year. Market liquidity turned marginally tighter towards the end of January, while monthly new CNY loans may have jumped seasonally from December. The size likely narrowed versus January 2023, as the central bank urged banks to smooth out lending throughout the year. Now, as we highlighted in earlier podcasts this year also, China needs to carry out meaningful stimulus in order to boost the demand side of the economy to overcome the threat from balance sheet recession. Now, so far, most of the stimulus was to boost liquidity in the system, but issues in the property sector must be tackled in order to stem deflation and lower the real interest rate. Now, the Hang Seng Index broke above key resistance at 15,968 yesterday, but it is still on a downtrend. It needs to break the next two resistances, 16,253 and 17,135, in order to break the pattern of lower highs and lower lows. We continue to believe that the SOE is an area of interest. The government stated the inclusion of market capitalization management as one of the KPIs for the SOE's management. That can be an important element of support for the share prices of SOEs. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.